Hello and welcome to the appointment with Martin Wolf, Chief Economics Commentator at the Financial Times, London. I am Vivian Fernandez. Mr. Wolf is the author of many books, his latest publications being Why Globalization Works and Fixing Global Finance. Mr. Wolf, thank you very much for joining us.
It's a great pleasure.
I must confess that this is more a chance encounter for me than an appointment because the person who was supposed to do the interview has suddenly taken ill. But I'm delighted to have you over, and it would be a pleasure to draw on your insights. Now, you said in a recent column that world recovery is not going to be uniform, it's not going to be U or V, it's going to be love-shaped. So some economies are going to see a prolonged period of pain?
Yes, I think that's right. This love shape was invented, I understand it, by somebody called Sir Martin Sorrell, who runs a company called WPP, and advertising. So it's a good advertising word. The L stands for an L-shaped recovery, and the U for a U-shaped recovery, and the V for a V-shaped recovery. And the L applied to Europe, above all, the V to the United States and Canada too, and the V is for the emerging countries like India and China. In fact, they didn't really have a V because they never really fell very much, but remained with very strong growth. But if you look at the L countries, which is what you were asking me about, it seems pretty clear that at least at the moment, that the recovery in Europe is going to be very weak. These countries have had a bit of a bounce, and the Eurozone, of course, is having now a lot of trouble internally, which is probably going to affect the growth of the economy to some considerable extent. It's still very dependent on export demand. Internal demand is very, very weak in the Eurozone. So I think it is very plausible that growth in the Eurozone will not be much above 1.5% this year. Nobody knows. But that's very significant because we've had a very big decline. So that would mean at that rate years before GDP gets back to 2008 levels.
The markets are very edgy, and do you expect one of the European countries to go belly up?
Well, no, I think not, but one has to be very careful about these things. So much has happened that I didn't expect. So it's been so extreme in the last 2 years. I think there is now a lot of stress in the financial markets. It's particularly concentrated on Greece, a very small country. It is important to remember Greece is only 2.5% of the Eurozone economy. It's a very small country, like Alabama in the United States, as it were. It's not that significant. But they are clearly having now very great difficulty in selling their debt. The spreads, the gaps between the interest rate on Greek government bonds and German government bonds are now nearly 4 percentage points, so 400 basis points. This is a huge spread. And not so long ago, 2-3 years ago, it was nothing. It was next to nothing. So if it were to remain like that, at anything like those spreads, it would become really very difficult for Greece, which has a debt, very high public debt, about 120% of GDP, to continue to finance itself. And it would be in a potential default situation. There's no doubt about it. But my own guess is that if that happened, that it would be bailed out in some way. By
the IMF or by the European Union?
Probably by the the Eurozone itself. Possibly with IMF help, but unlikely. I think it's more likely that there will be some sort of guarantee put on that debt for a certain period of time. It will be designed to lower the interest rates, and if it did that, it would give the Greek government the time it needs to put through its austerity package and bring some credibility to its public finances. But it's getting pretty chancy, and if Greece gets into very serious trouble, that could start affecting other peripheral countries, and we could have a wave of quite considerable sovereign debt
what
problems.
does that tell for countries like India, which have a very high fiscal deficit, more than 10% of GDP?
Well, I tend to be more optimistic about India. The government debt ratio in India is high. The fiscal deficit is enormous, particularly since the revenue ratio is not high. So in this sense, India's fiscal deficit position and debt doesn't look too good. But I think it's important to remember that it's financed internally. India has very high savings. national savings. The households in India are very frugal. It's wonderful. The government is wasting it, of course, in part. I think it's a pity, great pity, because a lot of the spending is not very useful. But the Indians are financing it themselves. And the second thing you have to remember is India is a high-growing, fast-growing economy. So with a fiscal deficit of 10% of GDP, but nominal GDP in India is growing in the teens, that means that this is actually quite a stable situation in terms of the debt ratio. It's very different for a country to have a 10% debt ratio and real GDP growth, 10% deficit, and real GDP growth is only 2%, and nominal GDP is growing at 4%. But here it's growing at, I don't know what the exact figure, maybe 14. Maybe it's maybe more. So in this situation, I think India's deficits do not create solvency questions, but I think the issue for India rather is, given that this is still a poor country overall, given that the savings of the people are hard-earned savings, wasting them on food subsidies and fertilizer subsidies and petroleum subsidies just seems to be a waste of money. They would be. It's not the deficit, in other words, that worries me. What worries me is how the government is using the money.
What do you make of the quality of U.S. growth? Because one commentator, Larry Summers, the former presidential advisor, he has said that it's more a statistical recovery, human recession.
Yes, he said that at a panel that I was chairing, so I remember
in Davos.
He's saying that. Well, I think he's right. I mean, that's true actually throughout the developed world. But it's particularly severe in the US, and very fascinating. It's not quite clear why this has happened. The US actually has had in 2009 an enormous productivity growth, about 6%, which is quite extraordinary in a recession. So what happened is that in the usual American way, they fired workers very, very quickly as soon as the recession hit. The recession turned out to be much milder than people expected. The economy only shrank by about 2.5%. People expected something much worse. So unemployment shot up, joblessness shot up, and it's become a huge social problem. Now they're beginning to get a recovery, but so far the labour market still isn't picking up. Now, I think there is some optimism, though nobody is sure, that maybe American companies have sacked more workers than they needed to. They realize that the economy wasn't quite as dreadful as they expected it to be a year ago, so they may well start rehiring, and in that case this human recession may start going away, and then optimism would return. It'd be very, very good for the president. It would because that's the main problem he has. In truth, it's not his mistakes. It's just that we have this terrible unemployment data. Europe, interestingly, is the obverse. The contraction in the economy in Europe has generally been worse than in the United States. Only France has had such a mild recession. Everywhere else it's much worse. But unemployment has not risen so much because of job sharing, more inflexible labour markets and so forth. So unemployment hasn't been quite as big a problem. We've worked harder in Europe to shield people. But that may also mean that the recovery is weaker. So it's an indication of the differences in the economic systems of the two regions in the developed world.